The Subcommittee on Commerce, Trade, and Consumer Protection will now come to order. The purpose of today's hearing is to hear witnesses on the subject of the proposed Consumer Financial Protection Agency, implications for the consumers and the FTC. And I certainly want to welcome all the witnesses, Mr. Barr and Chairman Leibowitz. The chair recognizes himself for 5 minutes for the purposes of an opening statement. I would like to thank all my colleagues and all the witnesses who diligently worked to prepare testimony over the 4th of July holiday so that today's hearing would be as meaningful as possible as we commence our examination of the administration's proposal to create a new Consumer Financial Protection Agency. My view on the matter is fairly straightforward. I believe that the FTC should remain intact as it is currently constituted, and that this committee and subcommittee should continue to oversee and authorize the FTC. The commission, which was established in 1914 during our nation's progressive era, was designed to be a regulatory agency with disinterested expertise to ensure competition and to promote free enterprise. That mission and those prescient concerns are as vital today as they were almost a century ago. The Commission operates best as a lone eagle. From high above, the agency can survey the marketplace and swoop down on predators that deceive unsuspecting and misinformed consumers. The higher and farther away that the FTC is from other agencies and the entities that it regulates, the better it is at spotting unfair commercial and trading practices and at isolating those practices that cast the longest shadows. Similarly, by staying at a distance, the agencies can keep would-be captors at bay while staying on course to achieve its critical mission of protecting consumers. Looking at all reliable indicators, the Commission has performed commendably for small and scrappy staff and abridged powers. Working along with a 5-person bipartisan commission are approximately 1,100 dedicated employees spread out across 3 bureaus: Bureau of Competition, Consumer Protection, and Economics. Although its expertise is deep and broad, the FTC's statutory tools under the FTC Act consist of an antiquated and cumbersome form of rulemaking under the Magnuson-Moss Act paired with anemic litigation authority. These tools may be successful at landing glancing blows, but they fail to pack the full punch of deterrence that businesses will respect and consumers deserve. Currently at the FTC's disposal are its expertise and its agency-crafted instruments of research and policy and study development, consumer complaint and education, competition, legal analysis, and economics. What the FTC does well, it has done without peer relative to its sister agencies. And what it hasn't done particularly well is well in the process of being fixed. Just a few weeks ago, our subcommittee worked intently to mark up H.R. 2309, the Credit and Debt Protection Act, which directs the FTC to adopt rules using APA rulemaking authority that will address rampant, unfair, and deceptive acts and practices in the area of payday lending, automobile finance, mortgage and foreclosure rescue, and debt settlement. Our subcommittee's objective in passing H.R. 2309 was to confer more authority upon the FTC and equip it with sufficient resources so that it could adopt rules faster in the areas of credit and debt through APA rulemaking procedures and bring enforcement actions carrying the threat of civil penalties. Our committee has worked devotedly in the past more than a few times with members from the Financial Services Committee to bolster the FTC's shortcoming, hold out the FTC's best practices for banking agencies to emulate in protecting consumers and to improve the ability of bank regulatory agencies to protect consumers by issuing unfair and deceptive rules under the FTC Act. I have witnessed the respective chairs of the committees on Energy and Commerce and Financial Services jointly introduce H.R. 3525 to tackle some of these challenges. Further, I offered a friendly amendment to H.R. 3526, which was introduced by the chair of the Financial Services Committee in the 110th Congress, to require that a GAO report investigating federal banking and credit union regulations and the perpetuation of unfair and deceptive acts and practices by depository institutions. Importantly, this push and pull between our respective committees has pressured the providers of financial services and products, including banks and depository institutions, to balance the allure of profits and determination of safety and soundness against the needs of consumers. This collaborative working relationship between committees has produced good and sensible consumer protection bills to safeguard consumers of financial services and consumer credit products. It is a viable example of the independent agencies that will be affected by the administration's proposal, as it will allow each of them to maintain their independence and respective biases, experience, and expertise when addressing serious problems that cut across industry sectors and affect market suppliers and consumers. I want to thank the witnesses for being here today, for taking out time from their busy schedule to be and to participate in this hearing. With that, I yield back the balance of my time. The chair now recognizes the gentleman from California, the ranking member, Mr. Radonovich, for 5 minutes for the purposes of the vote.
Thank you, Mr. Chairman, and good morning. I appreciate your calling today's hearing on this important topic. Whenever something goes wrong in this country, Washington proposes a solution, regardless of whether the situation calls for one. However well-intentioned our actions, they rarely work out because they are often undertaken as a knee-jerk response. We have seen many unintended consequences of rushed legislation in recent history. For example, the Sarbanes-Oxley Act. At best, we have seen marginal improvement in the markets while diverting billions of dollars toward new compliance costs to the detriment of many small and medium-sized businesses. In another example, last Congress, we enacted a law in response to lead paint on toys. The paint violated an existing standard, but what was a compliance problem rather than a deficient standard problem led to numerous costly new mandates that put many small and medium-sized businesses out of business because the cost was too high without any corresponding increase in safety. This is not to say that weaknesses in our financial system don't exist. They obviously and clearly do. The failure of so many financial institutions and the ongoing problem of foreclosures on mortgages some borrowers never should have taken out are evidence of that. And if the bailout of banks and financial firms really were necessary to save the financial system, something clearly needs to be done to address the systematic risk. Additionally, fraud and deception by both lenders and borrowers in the mortgage market ran rampant. The FBI reported an increase in fraud by more than 400% since 2005. Few people questioned anything was wrong in the market until home prices started plummeting and borrowers began defaulting. If uniformity in the enforcement of existing laws can address these problems, I would support that. Apart from the lack of systemic risk, regulator to prevent future financial collapses required in the taxpayer bailout, I am still trying to understand what holes exist in the FTC's Consumer Protection Authority and to what extent the government contributed to the crisis with its intervention in housing policy. I am far from convinced that the market problems require the creation of a new federal regulator as contemplated by the administration's proposal. Fannie Mae and Freddie Mac are under government control in part because they did exactly what Congress and the government wanted: extend home ownership to as many people as possible under the watch of the federal regulators. Fannie and Freddie, along with the federal housing agencies and programs, were encouraged to extend credit, and when they did, they and their shareholders paid the price for failing. To accomplish the policy goal of extending home ownership to as many people as possible, changes in lending standards had to occur. The lowering of lending standards meant more borrowers qualified for loans they couldn't afford. My point is that laws on the books didn't stop people from taking out riskier mortgages, either in spite of or because of rapidly increasing home prices. Nor has it stopped regulators and law enforcement from prosecuting those who we now know committed fraud and broke the law. While many experts believe that the banking regulators performed their duties inadequately, I will leave that to the Financial Services Committee to decide. But with regard to the FTC, it seems to me that we are throwing out the baby with the bathwater by stripping the authority over consumer protection for financial products and services from the one agency that has performed well. If we agree we need legislation, we should take the approach of legislating with a scalpel rather than with a bulldozer. With that said, I have two primary concerns with this proposal. First, it creates a new federal entity with an enormous scope of authority. The proposal grants sweeping authority to a new agency over financial products that would cover every sector of the economy. As I understand it, the draft legislation would touch everyone from a certified public accountant to a realtor and subject them to a new tax to fund the agency. Second, I'm concerned about transferring functions from the FTC to a new agency without any evidence that it is necessary or that it will be as effective as a regulator as the FTC is. By removing the FTC's authority, we could lose the FTC's unique expertise in balancing consumer protection and competition. Finally, the legislation contains several new broad authorities for the FTC regarding rulemaking authority and civil penalty authority. I have previously disagreed with these and do not need to repeat them at this time. However, I do have some questions of the witnesses regarding these provisions, and I will ask them when they are appropriate. I want to welcome the members to the panel as well, and yield back, Mr. Chairman.
The Chair thanks the gentleman. The Chairman of the full committee is recognized for purposes of opening statements for 5 minutes.
Thank you very much. I want to thank you, Mr. Chairman, for holding this important hearing. Last year, as chairman of the House Oversight Committee, I held several hearings examining the causes of the financial crisis. Those hearings revealed a government regulatory structure that was unwilling and unable to meet the complexities of the modern economy. We found regulatory agencies that had fully abdicated their authority over banks and had done little or nothing to curb abusive practices like predatory lending. The prevailing attitude was that the market always knew best. Federal regulators became enablers rather than enforcers. The Obama administration has developed an ambitious plan to address these failures and to strengthen accountability and oversight in the financial sector. Today's hearing will take a close look at one piece of that plan, the proposal to create a single agency responsible for protecting consumers of financial products. A new approach is clearly warranted. The banking agencies have shown themselves to be unwilling to put the interests of consumers ahead of the profit interests of the banks they regulate. And the structure and division of responsibilities among these agencies has led to a regulatory race to the bottom. The Federal Trade Commission has taken steps to protect consumers, but its jurisdiction is limited, and it has been hampered by a slow and burdensome rulemaking process. I'm pleased that this subcommittee is holding today's hearing and examining the administration's proposal carefully. There are two areas in which attention and focus from this committee are particularly needed. First, the new agency must be structured to avoid the failures of the past. It only makes sense to create a new agency if that new agency will become a strong, authoritative voice for consumers. And second, we must ensure that the Federal Trade Commission is strengthened, not weakened, by any changes. Unlike the banking agencies, FTC has consumer protection as its core mission. In recent months, FTC has taken great strides to protect consumers of financial products, bringing enforcement actions against fraudulent debt settlement companies and writing new rules governing mortgages. The administration's proposal would give most of the FTC's authority over financial practices and some of FTC's authority over privacy to the new agency. At the same time, the administration proposes improving FTC's rulemaking authority and enforcement capabilities. It's not clear what impact these proposals would have on FTC or its ability to perform its consumer protection mission. As we build a new structure for protecting consumers of financial products, it's our responsibility to ensure that we do not weaken the agency currently responsible for consumer protections in this and many other areas. Once again, I thank Chairman Rush for holding this hearing. I welcome our witnesses to the committee. Look forward to their testimony.
The chair thanks the chairman of the full committee. And now the chair recognizes the gentleman from Florida, Mr. Stearns, for 2 minutes for the purposes of opening statement.
Good morning, and thank you, Mr. Chairman. This is a very important hearing. It's important for us as members of this subcommittee, and Mr. Chairman, in terms of our jurisdiction and what the implications are for jurisdiction in the future. The administration's newly proposed CFPA, or the Consumer Financial Protection Agency, is relevant. It's an idea that a lot of us have mixed reactions on, has implications for our subcommittee. Although this is only one component of the administration's broad-reaching financial regulatory reform proposal, it certainly is an important part of that overall program, and it needs detailed examination. We must carefully consider the long-term effects that this will have on the Federal Trade Commission, the consumers it is charged with protecting, and on industry. Currently, the Federal Trade Commission has broad authority to protect consumers from unfair and deceptive practices in the credit and debit debt areas, and the FTC has notably been an effective and reliable agency in terms of consumer protection. We've seen it on this subcommittee. However, this new agency, the CFPA proposal, strips the Federal Trade Commission of virtually all of its consumer protection authorities pertaining to financial practices, and even some of its privacy protection authority. So, Mr. Chairman, I think that's got to be concerned. The proposal compensates for this shifting of authority by granting the Federal Trade Commission streamlined Administrative Procedures Act, APA, rulemaking authority and the ability to seek civil penalties against unfair and deceptive practices. But this is a term which there's no clear definition, as well as making it unlawful to, quote, aid and abet, quote, in deceptive acts. So due to the shifting of power and the potential economic consequences of businesses, we must ensure that effective stakeholders have a voice at the table, but ultimately we need to be assured that the CFPA, the new agency, will be an agency designed to do what is in the best interest of the consumers and not what is in the best interest of the bureaucrats who run it. One other concern I would have, Mr. Chairman, with the APA is it has 180 days for consideration. Is this sufficient time? Under the Mag-Moss Act, rulemaking requirements included a public hearing. And so, Mr. Chairman, perhaps as this bill moves along, we might want to include some kind of public hearing as incorporated, as well as this 180 days of consideration. And with that, I yield back to my balance of my time.
The chair thanks the gentleman. The chair now recognizes the gentleman from Michigan, the chairman emeritus of the full committee, my friend, Mr. John Dingell, for 5 minutes for opening statements.
Mr. Chairman, I thank you, and I commend you for this hearing. It is a very important one. It follows on a series of events which began with a raid on this committee by other committees and by the banking industry, and by repeal of Glass-Steagall, which removed all the penalties and prohibitions against many of the illegal activities which brought us to the current lowest state in which we find ourselves financially and economically. At the Treasury Department, there was an office still in being called the Comptroller of the Currency, who pushed to totally deregulate the banks and to unlearn the lessons which we learned during the Depression, and to permit the abuses which the Pecora Commission found to be a problem. Things which brought about the 1929 crash. And lo and behold, the failure to learn those lessons or to preserve the protections which the Congress and the President in the 1930s put into place led to the economic collapse which occurred in the United States in the last calendar year and this calendar year. So the questions that we are watching are very close. The questions that we will be concerned with is going to be, are consumers protected? Is the Federal Trade Commission able to continue doing the work that it does to protect consumers? And this committee is going to concern ourselves this morning with these issues and means by which to ensure improved consumer protections continue to exist with regard to financial products and services, and to see to it that the Federal Trade Commission is able to carry out the responsibilities which in a rather contemptible fashion were disregarded by the SEC and also by the Comptroller of the Currency. Now, we need to know if our concerns here and the pause which it gives us occurs in part because of a transfer of existing authority from the Federal Trade Commission to a newly minted Consumer Financial Protection Agency, an agency whose behavior we don't know, but an agency which is going to probably be composed of many of the good-hearted people who have brought us to this curious and unfortunate state of events. I will be truthful, I have significant concerns about these plans, and I will be intending to engage today's witnesses in a frank discussion about their merits. The administration, which has no fault in the events of the deregulation and the collapse of the American economy in last year, envisions consolidating all consumer protection functions related to financial products, including rulemaking, supervision, examination, and enforcement under the aegis of the new CFPA, which would receive sole rulemaking enforcement authority over consumer financial protection statutes such as the Truth in Lending Act. At first glance, this strikes me as a de jure and possibly unwarranted reassignment of FTC's consumer protection authorities in the financial services area. I will be looking to see whether this is so and whether, in fact, it is a good thing or can be justified by the administration. While a comparatively small agency, it is to be observed that FTC has done superb work in protecting consumers. And in this, the country would benefit not from a diminished mandate to that agency, but rather to additional statutory authority, personnel, and funding. Consequently, I have more than a modest degree of skepticism regarding the administration's proposal. In brief, I wish for our witnesses to elucidate upon several matters associated with the CFPA proposal. First, if CFPA were mandated under law, what authorities would be left to FTC? and why would that occur? Second, what latitude would FTC have in enforcing consumer protection statutes as they relate to financial services? And what consumer protection statutes would be denigrated or dissipated under this proposal? Third, how would one characterize the level of interagency cooperation in the drafting of the administration's proposal? Finally, if CPA receives its proposed mandate, what will become of this committee's jurisdiction over consumer protection as designated under Rule 10 of the House of Representatives? I will welcome the witnesses' responses to these and other questions in order to properly establish an adequate record for additional action by the Congress, if such is deemed necessary. I would ask at this time that I have unanimous consent to keep the record open, to submit a list of questions to the witnesses today, and to have those responses and the questions inserted into the record. I want to commend you, Mr. Chairman, for your courtesy and foresight in this hearing. I would conclude by a personal note in welcoming Dr. Stephen Calkins, Associate Vice President for Academic Personnel and Professor of Law at Wayne State University in my home state of Michigan. His testimony has been invaluable to my understanding of this matter, and I look forward to his participation in the continuing debate on consumer financial protection. And I note, Mr. Chairman, that my wife is a member of the Board of Governors of that great institution, which gives me a particularly warm feeling about it. And again, Mr. Chairman, I urge you and my colleagues to be most diligent, most cautious, most careful, and most dutifully suspicious of the events that we inquire into today. Thank you.
Mr. Chair, thanks the Chairman Emeritus. The Chair want to put before the committee the UC request, and hearing no objections, so ordered the UC request by the Chairman Emeritus. And the Chair also wants to take a moment of personal privilege to to celebrate the Chairman Emeritus' birthday and to wish him a happy birthday. So we want you to know that we all wish you a very happy birthday and many, many more.
E3, a fellow's a little more careful about celebrating his birthdays. The good news is I'm celebrating my 83rd birthday. The bad news is that I'm 83. I thank you, Mr. Chairman, for your courtesy, and I thank my friends for their kindness and their courtesy.
Thank you. The Chair now recognizes the gentleman from Kentucky, Mr. Whitfield, for 2 minutes for opening statements. Right, excuse me, I didn't see Mr. Barton there. He just walked in. Okay. He usually walks with a much bigger step. Mr. Barton is recognized the...
Well, you can go to Mr. Whitfield. He was here before me. I'm fine with going to Ed, and then come back to me after the next group.
Y'all work that out then. Okay. Mr. Whitfield.
We're all very polite today, so thank you very much. Mr. Chairman, I want to thank you also for holding yet another important hearing examining the ongoing financial crisis and ways we can help our constituents get through these difficult times and mitigate future problems. Secretary Geithner said that this new Consumer Financial Protection Agency would have only one mission, and that is to protect consumers. It's also my understanding that this proposal would eliminate the consumer protections at the FDIC, the Federal Reserve Board, the Comptroller of the Currency, and the impact on the FTC. Perhaps we should explore expanding the authority of the FTC. Another problem that concerns me about the proposed legislation is that there is no federal preemption of any state law that is more stringent than the federal law. And anyone that's gone through a mortgage process, and when they hand you the 45 pages of documents, you're going to find yourself getting more documents if you have these conflicting state laws on these consumer issues. And I think that's a real concern as well. But the problem that I have most of all is how much will this cost? Every day we pick up another article in a newspaper, growing national debt, maybe next economic crisis. Unless we demonstrate a strong commitment to fiscal sustainability in the longer term, we will have neither financial stability nor healthy economic growth. Interest payments on the debt alone last year was $452 billion. This year it's expected to be $470 billion, the largest federal spending category after Medicare, Medicaid, Social Security, and defense. Another article today, economist declares train wreck because of out-of-control federal budget deficits. The Economist talks about the real question is how much damage will greater indebtedness do to economic growth and government's creditworthiness. Those things may transcend what limited additional protection consumers get from this legislation. So I think we need to move cautiously, find out how much cost are we talking about here and what will the benefits be. And thank you, Mr. Chairman.
The chair thanks the gentleman. The chair now recognizes the vice chair of the subcommittee, my friend from Illinois, Congressman Schakowsky, for 2 minutes.
Thank you very much, Mr. Chairman. I just came from a roundtable on women's financial literacy, clearly an important issue. But what we have found is how daunting the environment has been for anyone who even is pretty literate in financial issues. We've seen the systematic production and marketing and sales of countless of financial products, including mortgages that were extremely risky, even downright dangerous for borrowers, and often it was pretty hard to figure out what was what. For years, bank and non-bank lenders operated with too little oversight by government regulators, and when regulation was taking place, there was little focus on whether the financial products and services sold were safe for consumers. The Federal Trade Commission, and I'm so glad its chairman is here today, is essentially the only agency with a mandate to prioritize consumer safety and protect Americans from unfair or deceptive practices. And I commend Chairman Leibowitz for his renewed commitment to consumers' rights in the areas of credit and debt. However, as has been mentioned, the FTC's jurisdiction is limited to non-bank activities. The agency has been hampered for decades by cumbersome rulemaking authority, and in recent years its actions were limited by the previous administration's general contempt for oversight of the private sector. Overall, current regulations aren't sufficient, and they aren't working. We can't maintain a system which neglects consumer protection for the bulk of the financial service industry. Americans deserve access to honest information that will help them make educated decisions on mortgages, credit cards, and bank accounts. Dangerous financial products should be kept off the markets, and advertisers must be held accountable for their claims. We have to move forward with these goals, and I look forward to hearing today's testimony on how a consumer financial protection agency might achieve them. Thank you, and I yield back.
The chair thanks the gentleman. The chair now recognizes the ranking member for the full committee, the humble and honorable Mr. Barton from Texas.
Well, thank you, Mr.
For 5
Chairman.
minutes.
Thank you. Before I give my opening statement, let me amplify what you said about our Chairman Emeritus, Mr. Dingell. Some people get 1 year of experience, and that's it. In his case, you could say that would be 1 year 83 times. But in Mr. Dingell's case, each year he adds it to the base where it compounds and amplifies by orders of magnitude. I think you can honestly say that our friend and Chairman Emeritus is the most influential member of Congress in our lifetime, and it is such a privilege to have him on our committee, and it is really fun when he is on my side. It is not so much fun when he is not on my side, but even then I learned from him. So heartiest congratulations from the minority side to a true gentleman of the House, the conveyor and the protector of institutional viability for this body. We wish you many, many more. With regards to this hearing, Mr. Chairman, I would bring the members' attention to today's Wall Street editorial op-ed piece about the particular agency. It's entitled, "Let's Treat Borrowers Like Adults." It calls into question whether there needs to be a super consumer financial products protection agency, which the legislation we're looking at today would empower. We accept the intentions being honorable, but people like myself have extremely strong reservations about the implementation of such an agency. What would the legislation actually accomplish that some federal agency isn't already attempting to do? We'd like to know what's gone so wrong with our existing protection agencies that we deem it necessary to create another brand new agency. I'm a bit taken back by the breadth of the proposed coverage. This legislation, of course, relates a great deal to banking and other financial institutions over which this committee, unfortunately, has no jurisdiction, at least not now. One never knows about the future. But it reaches beyond that. It could reach accountants, auditors, gift cards, all other types of institutions and entrepreneurial activities. It doesn't fall strictly within our jurisdiction because it applies to banks, but it's still of concern. There seems to me to be an exception that swallows the preemption rule. According to the proposal, if I understand it correctly, state consumer laws of general application and those state laws enacted pursuant to federal law intended to, and I quote, exceed or supplement federal law will now apply to any national bank. The Harvard professor who's credited with inspiring this all-inclusive Consumer Financial Protection Agency described the need for it in her article, Unsafe at Any Rate. Professor Warren wrote that we need this agency in order to reverse industry practices that make it difficult for consumers to understand what they are getting in a financial product world. For example, 30 pages of contract terms for a simple credit card or 50 lines of convoluted and excessive text to explain all required disclosures. I understand that. I just co-signed for my stepdaughter's new condo in Austin, Texas, and it took an hour of signing various documents, some of which were documents I signed certifying that I just signed the previous document. So I understand the need for simplicity and the need for perhaps a review of some of the existing documents that we're asked to sign, but I'm not sure that this agency gets there. This bill would assume that businesses and their customers are eager to pay more for such protection, maybe even a lot more, because there are no limits on the burdens to either. There are all kinds of reports this new agency could mandate, regular and special requests, but there are no limits to how often the agency could require those reports. And there's no mandate to consider the burden placed on the businesses to produce these reports. The preemption provisions really convey no preemption at all. In one paragraph, the proposal mandates all state laws are preempted, but only to the extent that they conflict. In the next, the legislation permits a state law to supersede federal law if the new agency determines the state law is more protective. That seems to be almost in direct opposition to the prior paragraph. What if a company is compliant with the federal law, but while the agency hasn't yet determined whether a state law is more protective, the Attorney General believes it is and brings action against the business for a violation? Is that company liable for its violations of state law without any notice? This would seem to exacerbate the decisions, but rather by making certain that the products themselves don't become the source of the trouble. I see my time is about to expire, Mr. Chairman. I have another page and a half of written commentary that simply put me down as extremely doubtful about the positive impact of this legislation. I think we'd be better served on this committee and your subcommittee to go in and reform existing authority, clarify the differences between existing regulatory agencies, and if there's something that has really fallen through the crack, try to figure out one of the existing agencies like the FTC and see if we couldn't give them explicit authority in that area that needs reinforcing. With that, Mr. Chairman, I yield back.
The gentleman from Texas, Mr. Green, for 2 minutes for opening statements.
Mr. Chairman, thank you for holding this timely hearing to examine the administration's proposal to create a new agency that would consolidate and be responsible for consumer protection with regard to financial products and services. After the events of last year, there should be no doubt that Congress needs to act to further protect consumers with regard to financial regulation. This subcommittee has already taken steps to address this by moving forward legislation H.R. 2309, the Consumer Credit and Debt Protection Act, to give the Federal Trade Commission additional powers to better address consumer credit and debt issues. It was widely agreed in the hearings that the legislation that will, with the added authority H.R. 2309 would provide the FTC, it should take a broader and more effective role in consumer financial protection. With regard to the new tools, this proposal would give the FTC, the administration has addressed many of the problems that have hamstrung the Commission from taking steps to implement additional financial consumer protection, particularly with regard to the FTC rulemaking process. Magnuson-Moss procedures are lengthy and cumbersome and can prevent the FTC from taking action on widespread problems in a timely and efficient manner. So I strongly support the provision in the administrative proposal that grant the Commission authority to conduct rulemaking authority under the Administrative Procedures Act. The proposal also follows 2309, granting the FTC authority to seek civil penalties for any violations of Section 5 of the FTC Act, which would provide a great deterrent to would-be actors. The portions that I propose I'm less certain about, however, would move nearly all the FTC's Consumer Protection Authority for financial practices to the newly created Consumer Financial Protection Agency. I do not disagree that additional law enforcement is a good thing for the consumers. My main concern is we're adding a new enforcement regime that is siphoning off authority from our nation's primary consumer protection agency, when that agency is more than capable of doing the job given the necessary tools and funding. Many consumer protection functions the new agency would be responsible for would be moved from other agencies and departments that do not have consumer protection as their primary function. However, this is not the case of the FTC, and I look forward to hearing from our witnesses and why the administration believes the FTC should not continue these roles. And again, Mr. Chairman, I thank you for the timeliness of the hearing. I look forward to exploring with regard to this bill and look forward to the best paths to protect consumers.
Chair, thanks, gentlemen. Mr. Pitts is recognized for 2 minutes for the purposes of opening statements.
Thank you, Mr. Chairman. Thank you for holding this important hearing on the administration's proposal to create a new agency responsible for consumer protection. I think we all agree that we need strong consumer protection measures. The recent housing and credit crisis our country has faced makes this abundantly clear. We must do this prudently, though, avoiding the mistakes of the past. It seems, however, the proposal we have before us creates yet another divided system of regulation, making rooms for gaps in oversight. We saw the effects of divided regulation at Fannie Mae and Freddie Mac, where two regulators meant less regulation, not more. The proposed new agency would also have the authority to set prices, rather than allowing costs to be determined by consumers in the marketplace. Everything from ATM fees, check overdraft fees, and late payment fees for credit cards would fall under the purview of this new agency. Instead of adding layers of bureaucracy to financial regulation and intervening in the marketplace, things we've tried in the past, we should work to bring transparency and consumer choice to our markets. Consumer financial protection is a worthy goal. Unfortunately, increasing the layers of bureaucracy in the financial industry has not protected consumers in the past, and I see no reason why it will this time around. Again, we all desire effective and efficient enforcement of consumer protection laws. It is my hope that this committee moves forward in a wise and careful manner with increased transparency and consumer choice as their primary goals. I look forward to hearing from our distinguished witnesses. Thank you, and I yield back.
The chair now recognizes the gentleman from Texas, Mr. Gonzalez, for 2 minutes for the purposes of opening statement. Waive opening. The chair now recognizes the gentlelady from California, Ms. Matsui, for 2 minutes.
Thank you, Mr. Chairman, and thank you for calling today's hearing. I applaud your leadership in addressing this important issue. I'd also like to thank the witnesses for joining us today. In today's economic recession, many families in my home district of Sacramento are struggling to make ends meet. I've heard countless stories of people struggling to keep their homes, their jobs, and their way of life. California, and in particular my constituents in Sacramento, have been greatly impacted by the economic crisis. Many of my constituents were and continue to be victims of predatory home loan lending, unfair credit card practices, payday loans, and other forms of unscrupulous business practices. Just recently, the President signed into law credit card reform legislation to regulate unfair credit card practices. The ink is hardly dry, but companies are already trying to find ways to arbitrarily raise credit card interest rates and fees on consumers. Struggling homeowners are also seeking assistance to keep their homes, but continue to be tricked into contacting scam artists who just so happen to be the same crowd that initially steered homeowners into subprime loans. This is all occurring as job losses mount, foreclosures continue to rise, and Americans are increasingly turning to other forms of credit to make ends meet. It is clear that consumers are not being properly protected from unfair and deceptive financial practices. When is enough enough? The President's proposal to create a new financial consumer protection agency could be the answer the American consumers are seeking, but it must be done in a thoughtful way to ensure consumers are protected from fraudulent activity. We must make sure any new agency has real authority and just as much bite as it has bark. Consumers need to feel protected and have confidence in our financial system. Right now, it's clear they do not. I thank you, Mr. Chairman, for holding this important hearing today, and I look forward to working with you in the committee on this issue moving forward. I yield back the balance of my time.
Chair thanks the gentlelady. The chair now recognizes the gentleman from Nebraska, Mr. Terry, for 2 minutes.
Thank you, Mr. Chairman. I'll try to be quick. I think the fundamental premise of this proposed or this bill is that the FTC, the entity in charge of protecting consumers, has evidently been an abysmal failure. I don't agree with that premise. I think the issue should be how do we make sure that the FTC is properly empowered to protect consumers, and that should be what we are working for, as opposed to stripping away whatever jurisdiction they have over protecting consumers and creating some monolithic new government agency in replace of what already exists. So I'm very skeptical of this process or this bill, and I look forward to hearing from our witnesses so we can determine if FTC is capable of doing what they have been doing and whether or not this bill is even necessary. So I yield back.
The chair recognizes the gentlelady from Michigan, Ms. Sutter, for 2 minutes. Sutton.
Thank you, Chairman Rush, and thank you for holding today's very important hearing on the newly proposed Consumer Financial Protection Agency. As Elizabeth Warren aptly stated in describing the need for an agency like this, quote, "It is impossible to buy a toaster that has a 1 in 5 chance of bursting into flames and burning down your house. But it is possible to refinance an existing home with a mortgage that has the same 1 in 5 chance of putting a family out on the street. And the mortgage won't even carry a disclosure of that fact to the homeowner," end quote. Unfortunately, many people in my district who were preyed upon by so many unscrupulous companies, people know this all too well. The well-known and tragic case of one of my constituents, Addie Polk, is a shocking example of a financial product that not only caused someone to almost be homeless, but caused someone to attempt to take their own life. At the age of 86, Ms. Polk was given a new 30-year mortgage on a house she already owned, and for an amount greater than the value of her house. Let me say that again. At the age of 86, Ms. Polk was given a new 30-year mortgage on a house she already owned and for an amount greater than the value of her house. Less than 4 years later, Ms. Polk, probably of no surprise to the person who sold the mortgage to her, began to have trouble making her payments, and her house fell into foreclosure. Feeling trapped and without options, Ms. Polk shot herself rather than lose the house she lived in for 40 years. No one ever should be in Ms. Polk's position. Now is our chance, in honor of Ms. Polk and countless other Americans who have found themselves the unfortunate owners of financial products with indecipherable terms, smoke and mirror-like provisions, and gotcha fees, to truly support strong consumer protection. I look forward to hearing from the panel about how we make sure we provide the needed protection, and I yield back.
The chair thanks the gentlelady. The chair now recognizes the gentleman from Georgia, Dr. Gingrey, for 2 minutes.
Mr. Chairman, I thank you, and I thank you for calling the hearing, and welcome back John Leibowitz and Honorable Barr, the Assistant Secretary of Financial Institutions. I associate my remarks really with what the gentleman from Nebraska on our side just said, Mr. Terry. Here we are creating a whole new federal government bureaucracy when we have one already that's doing a heck of a job, as it certainly seems to me, and I think most members on this panel. So the question becomes, you know, why, to use a medical expression, throw the baby out with the bathwater? If the FTC is doing the right and proper job and the right and proper oversight, and all of a sudden we come in and spend more federal dollars, as the gentleman from Kentucky was talking about earlier, about creating a whole new federal bureaucracy. So again, I'm happy to hear from the witnesses, and maybe they can explain that. Hopefully they will explain that. But I think this is something that we need to look at very, very carefully as we just continue to create one more, or to consider creating one more government bureaucracy at a time when we're running billions of dollars of deficit year after year after year. And with that, Mr. Chairman, I'll yield back.
The chair recognizes the gentlelady from Florida, Ms. Castor, for 2 minutes.
Thank you, Chairman Rush, for calling this critically important hearing on the Obama administration's proposal for a Consumer Financial Protection Agency. Last Congress, in the wake of widespread concerns about toxic lead in paint, on children's toys, and other toxic consumer products, this subcommittee originated legislation to reorganize and strengthen the Consumer Product Safety Commission. And last year, as the economy plunged, there were some analogous terms being used to describe some of the mortgage and investment products. We heard about toxic assets poisoning banks' balance sheets and toxic mortgage products, leaving millions of our neighbors facing foreclosure. Predatory lenders wreaked havoc on my community, and the subsequent significant decline in property values has affected millions of folks in my home state. And unfortunately, consumers could not count on state oversight of these mortgage brokers in my home state. They just turned a blind eye, and I recommend the Miami Herald expose that documented how many convicted felons entered into the subprime mortgage loan marketing business. So this financial crisis has taught us that in order to maintain a healthy economy, effective regulation must focus on protecting consumers from abusive, deceptive, and unfair lending practices. The FTC has the enforcement authority to go after only non-depository lending institutions that deal unfairly with their borrowers, but the abuses that led to the financial crisis spread deep into the banking system. So in light of the need for more effective regulation of all lending institutions, depository and non-depository, the Obama administration has rightly proposed a reorganization. And I think all of us can agree that regulation of financial institutions must be improved to better protect consumers. However, we must be aware not only of the impact of granting authority to a new consumer financial protection agency, but also of the consequences to consumers of the changes that have been proposed to the FTC. The administration's proposal would reshape the FTC by shifting authority over consumer credit but also by streamlining its rulemaking process and allowing it to assess civil penalties on bad actors. So I look forward to your testimony on what this new FTC might look like and how its ability to achieve its mandate of consumer protection will be affected. I yield back.
The chair now recognizes the gentleman from Louisiana, Mr. Scalise, for 2 minutes.
Thank you, Mr. Chairman. I want to thank you and the ranking member for having this hearing. The administration is proposing yet another new federal agency with vague sweeping authority. We all know there have been bad actors in our financial system that took advantage of consumers and contributed to the current economic crisis. Unfortunately, many of the problems that brought on today's financial crisis are not even being addressed in this bill. The proposed legislation does not address the real bad actors in our financial systems. Fannie Mae and Freddie Mac and other institutions that engaged in subprime lending and relaxing their standards to encourage more people to take out loans they could not afford. Those warning signs were brought before Congress for years, and yet many of the same people in this administration and in the leadership in this Congress are the same people who oppose the very reforms that would have prevented this financial crisis from happening in the first place. This proposed new agency represents yet another step in the federal government trying to run all aspects of our lives. The government is running banks and car companies with disastrous results. The so-called stimulus bill, which spends $787 billion of money we don't have, is now being recognized even by this administration as a failure that didn't create any jobs that were promised. There are even some in this administration floating the reckless idea of yet another massive spending bill since the last one didn't work. Scores of experts predict that this administration's cap-and-trade energy tax will cost us millions of jobs while increasing electricity rates on all American families. We're debating a bill that proposes a government takeover of health care, which has been tried and failed in other countries, to the point that sick people with the means in those countries come here to get their health care because government-run health care leads to rationing everywhere it's been tried. Now we have this bill to create a consumer czar. Enough is enough. Let's fix the problems that exist and make reforms to federal agencies that are causing these problems, rather than adding yet another layer of government bureaucracy that simply covers up the root causes of the problem while punishing those who played by the rules. I look forward to hearing the comments from today's panel and would like to hear how the administration's plan impacts the FTC. In his testimony, Chairman Leibowitz speaks to the successes the FTC has had in protecting consumers in financial matters, which begs the question why we need a new agency with all these sweeping new powers and spends more money that we don't have. I yield back.
The chair now recognizes the gentlelady from Colorado, Mr. Gett, for the chair. Thanks, the gentlelady. The chair recognizes the gentleman from Ohio, Mr. Space, for 2 minutes. With that, the chair thanks the gentleman. The chair recognizes now the gentleman from North Carolina, Mr. Butterfield, for 2 minutes.
Thank you, Chairman Rush, for holding this very important hearing, and I especially want to thank the witnesses for their testimony today. Mr. Chairman, I hope this hearing will provide an opportunity for the subcommittee to address some concerns that we have about the proposed agency, particularly the loss of jurisdiction on the part of the Federal Trade Commission. Now, my colleagues are right, Mr. Chairman. There are many actors to blame for the current state of our economy. Unscrupulous subprime mortgage lenders and speculators and the lack of effective oversight have all contributed to the financial meltdown. Of deep concern, and rightfully so, is the regulatory patchwork of federal agencies charged with regulating all aspects of financial institutions. For example, depository institutions such as banks and credit unions are overseen by many different agencies. Conversely, all non-depository institutions are overseen by one agency, and that is the FTC. The FTC has done a good job, and I think we can all agree on that, at regulating these players, and I am concerned that reducing FTC oversight as part of the creation of the Consumer Financial Protection Agency may do more harm than good. While I'm pleased that the administration's proposal seeks to strengthen the FTC's rulemaking and enforcement abilities in areas unrelated to financial products, I believe that it is extremely important that the FTC maintain strong non-depository institution oversight. The administration's proposed agency would seek to achieve 4 important objectives aimed at bolstering consumer confidence in financial institutions and transactions. These objectives include ensuring consumer education and understanding of these financial products, better protection consumers better protecting consumers from unfair and deceptive practices and discrimination, ensuring consumer financial services operate fairly, making certain that underserved communities like my district have increased access to financial services. These are excellent objectives, and I strongly support the goals of the proposed agencies, but I want to be certain that the creation of a new regulatory agency will not place undue and unnecessary strains and burdens on existing federal regulatory frameworks that may still be capable of meeting those same goals and objectives. And so, Mr. Chairman, this hearing today is vitally important. I look forward to hearing the testimony of the witnesses, and I thank you for the time.
The chair thanks the gentleman.